Thanks, Jeremy. I guess we'll be walking through some slides online, but we're also happy to take questions as we go in the chat. If you folks want to just type in, we'll try and catch them as we go. I'll probably spend about 10-15 minutes going over the basic strategy along with my partner Aman, and we can talk about our results from previous investments, also talk about the strategy overall and how we operate. And then we'll cover maybe a little bit of a look at some of the example investments that we've done and how they're structured. Just to start off, as a summary of what we're doing, we're buying fund interests from investors in funds and sometimes also from the GPs in those funds. Usually we're buying them from funds that are between 5 to 10 years old with portfolios that are already winning. What do we mean when we say they're already winning? Well, we know that they already have some companies that have had success in both building their revenue and customer base, that they've been funded in later stages, typically at least at Series B or C. They're probably valued at ranges anywhere from maybe $250 million up to maybe $2 billion in market value. And we know that the investors have some experience and already have some wins on the table. You might wonder why people are actually selling to us if things are going so well, and we explain a little bit about that later. But in general, we're buying from non-institutional LPs who are maybe not in the game for as long as a more institutional, larger investor, and they might have liquidity needs along the way. We usually are able to buy these portfolios at about a 20 to 40% discount to NAV. That's not theoretical. We've already done that, and we'll show you some examples. And overall, the benefits of this strategy is that we can find portfolios that are already doing well. We can sort of cut the hold time in half, and we can jump in at the best part of the investment curve. We like to say skip the J curve, which is that first 4 to 5 year period when maybe the strategy is still shaking out for the investor and they're still trying to understand which ones are their winners and which ones are not. Again, we usually like to jump in after that's already occurred. We're raising a $150 million fund. We've already raised about 30 million of that. We'll talk a little bit more about the fund structure in terms, but let's maybe jump into some of the examples of what we've already done with this strategy. We started doing this strategy about 2 years ago, although we've been investors in venture capital for about 15 years. This was a strategy that we came up with and started working on over the past several years. We did some of our initial purchases in secondary as the COVID pandemic was starting to kick in. The strategy is not based on sort of anything that's COVID specific, although we did have some opportunities to get into some great portfolios at fairly substantial discounts, particularly because people were a little concerned about what was happening during that time frame. We've done 4 transactions over the last 18 months, excuse me. We've deployed about 20 million. Those investments are now up about 3x in the last 18 months, so roughly about a $60 million sort of value portfolio. All 4 of the transactions that we've done have worked out quite well, and they're all performing at probably about 2x or better. Just to give you an overall sense of how we approach this, we're usually identifying funds that are mostly here in the US, although we might be looking at funds that are also outside the US in a few geographies. Our areas of focus are probably in 3 categories: B2B SaaS, B2C and e-commerce and marketplaces, and fintech. My partner Aman and I have quite a bit of experience investing in those categories, and we feel like we have a good sense of how to evaluate them. In addition to buying portfolios at the fund level, we may also look at buying individual companies secondary within those portfolios. Usually the funds that we're looking at already have at least one big winner. Sometimes they have more than one. And in a few cases, we might find companies that we want to invest in directly, typically at least at Series B or C or later stages. Usually we're buying the assets themselves. In some cases, we may also bet on carry or invest in the profit structure that the GPs benefit from as well. As I mentioned before, we're raising about $150 million fund. We'll probably do at least 15 to 20 transactions within that fund where we're buying at the portfolio level or at the fund level. We expect those transactions to be at between, say, 5 to 25 million in size. And then within each of those portfolios, we might also do 1 or 2 company investments, and those could be structured as secondary investments co-investments or even working on pro rata rights that we may acquire. Those will be a little bit smaller, probably in the $1 to $5 million range, maybe in a few cases up to 10 million. And some of those we might make available as co-investment opportunities for our LPs as well. Overall, we expect we'll acquire interest in at least 15 to 20 funds and probably positions, we would guess, in about 20 to 40 unicorns, maybe up to 50 unicorns that are potential IPOs. Just again, to touch briefly on our backgrounds, Aman and I have been working together in various companies over the last 20 years. We've both been here in Silicon Valley for quite some time. Aman's got a lot of great university degrees that he probably overpaid for, but he went to these small colleges you may have heard of called Harvard and Stanford. I grew up on the East Coast and went to Johns Hopkins, had a degree in applied mathematics and engineering before coming out to the West Coast in the late 80s. We both worked together in the early days of PayPal. We were there just prior to the IPO in 2002, and then later by the acquisition by eBay. We met a lot of great folks there that we've also co-invested with, and also some great entrepreneurs. I stayed there for about 3 years. Aman stayed a little longer for about 10 years. Later, I started a company called 500 Startups. That's one of the portfolios that we have been buying fund interest from. I was there for about 8 years, managed the first 4 funds that we raised, and we did quite a number of investments, both in the US and all around the world. I also did a little bit of work with Peter Thiel and Sean Parker at Founders Fund before I started 500 Startups. And I've taught courses at Stanford University on venture capital in the past. I'll hand off to Aman to maybe give a brief thumbnail on his background as well, and then we can jump into our strategy.
Yeah, I think it's perfect. I think between you and Jeremy have covered most of it. The only other things I'd add, just as far as the team, I think is to get into the strategy. You'll see there's a lot of competencies required in a fund like this around deal sourcing, finding portfolios, managing those portfolios, and where we make most of our investments on a dollar-weighted basis is really Series B, C, D, and beyond companies that are in the pre-IPO window. Most of my career has been either at PayPal, where I was running finance from when it was a pre-IPO company itself to now a multi-billion-dollar company, and when I left in 2010, it was already a $20 billion market cap company. A couple of later stage stints as a CFO, including Sonos, and then finance and legal roles throughout my career. So when it comes to valuation, understanding some of the market context, helping to get companies public, helping to think about pricing and how they might fit in a public company IPO investor, and their mindset. That's stuff I've been doing for the last 20 years. So between the folks on the team, we have a good set of complementary skill sets.
Thanks, Aman. And I should also mention that Steph Shorter, who is also on the call with us, has been helping great. And she's also probably a little smarter than us. She's got a PhD in neuroscience, so very overqualified for helping us make sure that we get everything organized.
Definitely smart.
I'll jump in now and talk a little bit about our strategy and maybe a little bit about the history of secondary. So when we say the word secondary, it might mean a lot of different things to different people. Probably the initial market where secondaries became popular was in private equity. On this chart that I'm showing right now, the lighter green circles, starting maybe even a little bit before 2000, but these strategies became very popular in the private equity world and have grown considerably over the last 20 years. Rough estimates for that market size now, it's probably around $100 billion. It's very competitive, and there are very large firms, Collar Capital, Lexington Capital, which was just recently acquired by Franklin Templeton, several others that themselves run very large funds that are multi-billion-dollar funds. And they purchase LP shares, investor stakes in private equity funds that may be themselves, again, tens of billions of dollars in size. So that's become a very established market. We saw probably a 10x growth over the last 20 years or so. In venture capital, there's also a secondary market, although most of the secondary transactions that happen in the venture capital market are at the company level. And those, again, probably started around 2000, but became somewhat significant, notable maybe about 10 years ago. We started seeing secondary opportunities in venture capital even as early as after the dot-com crash. and then more substantially probably after the US and global financial crisis periods in 2008 and 2010. We estimate that the secondary market in venture capital is probably around $30 to $40 billion. But again, most of that is happening at the company level. I'll maybe jump forward a little bit and just talk about the differences between company secondary and fund secondary. Although we do both, we emphasize sort of fund secondary as where our emphasis is and where the opportunities lie. So when we talk about fund secondary, we're really talking about buying a slice of a portfolio at the fund level, usually from the limited partner or investor in the fund side, and sometimes from the general partner side. And when we're buying that, we're buying an equal share of the overall portfolio and all its underlying assets. So a common VC portfolio might start with about 30 to 40 companies. When we're buying it, there may already have been some write-offs and write-downs. There may be some companies that are already large and winning. And so we're buying an equal share of all the companies that are in those portfolios. If we contrast that with company secondary, or sometimes called direct secondary on the right-hand side, in that case, you're usually buying an equity stake in just a single company. So there are some similarities and differences there. On the left-hand side with fund secondary, we're buying a basket of assets. So there's a little bit more diversification, not as much concentrated exposure in just one company. Also a little bit different when you're buying an individual company secondary, it's a little easier to evaluate the one company as opposed to when you're buying a basket of assets, you have to evaluate all of those assets. And then somewhat different in fund secondary is it's a little easier to turn around and sell the company secondary asset. If you wanted to, you could sell that to another buyer or sell it even on a retail platform. That's not really the case with fund secondary, at least not typically. And so usually it's a little bit harder to turn around and flip that asset. As a result, there's a significant buyer opportunity and leverage advantage there. So when we go back, this is kind of the slide that we show people that really explains the overall strategy. And what we're looking at here is a venture capital fund over maybe a 10 to 15 year time horizon. As the companies generally become, more successful and more established and become larger, although many of the initial companies might get written off in the first few years. So let's say we're talking about a seed stage fund. Again, most of the funds that we are looking at probably start at below $50 to $100 million in size. They might have 30, 40, or 50 companies in them initially. But then over time, maybe a percentage of those companies will get to a later stage of development, maybe only a third to a half that might get to Series A, and then maybe again, half or less than half that get to Series B or C. So that period of time, we typically look at as a pretty risky time where you're starting with a large number of companies, but you know that probably a good number of them are going to fail or not grow substantially. And you may not know whether you're going to get any successes out of that whatsoever. But probably by around year 4, 5, or 6, hopefully some of the companies in the portfolio have gotten to a level of success where they're significantly larger in size, probably anywhere from say 5 to 10x, maybe even up to 20x their initial size. And probably a lot of the initial companies were written off or written down. So when we look at these portfolios that are typically 5 years or more older, we know that there's probably going to be at least 1 or 2 success stories in there. And probably it's a smaller number of companies that really comprise most of the economic value. So that's where we see a pretty interesting opportunity to buy these funds after we've seen a lot of the risk, sort of reduced and a lot of the value in the portfolio start to establish itself and grow. The underlying companies that are at these Series B or C or D levels probably are valued at anywhere from say 100 million, maybe up to $1 billion in value. They probably have 10, 20 million in revenue or more, and they're probably growing at 50 to 100% per year. Again, because these companies take a little bit longer to get public, we may see that there's still another 5 years or more before they get to an exit. These days, we're typically seeing companies take about 9 or 10 years to get to a public offering, in some cases even longer. So even though those portfolios are doing well, there may still be a few more years before they get to liquidity. And sometimes, not always, but sometimes, the investors may be looking for an early exit. And that's really the opportunity that we've identified. We've done quite a bit of investing over the last 10, 15 years here in Silicon Valley and around the world. And we know a lot of the people who've been doing investing both on the the general partner VC side as well as the limited partner and investor side. And like I was saying before, we've been able to buy those portfolios at a somewhat significant discount to their current value, at least 20%, and sometimes up to 30 or 40%. And so this is really a great opportunity for us to jump in, find portfolios that are already winning with companies that are on their way to an IPO, and kind of get a head start in the game by buying them at a slight to sometimes significant discount to value. One of the other benefits that we get from the strategy is that we're typically buying these portfolios when they're starting to make distributions, and we usually have a much faster turnaround time on our capital. So when we compare to a typical VC fund that might take up to 10, 12, 15 years to fully liquidate, and you probably wouldn't even see initial distributions back until maybe around year 6, 7, or 8, we expect to see returns probably at least 1x back within the first 2, 3, 4 years. And ideally, 2, 3, or 4x, maybe even more, return within a 5 to 7 year period. I'll stop there for just a second and maybe see if we have any questions, either from the chat, and maybe I'll give my partner Aman a chance to jump in and talk a little bit about the overall hold time and liquidity period for companies and funds.
Yeah, I can do that. I don't see anything in the chat right now. But as far as the holding time and what you can expect as far as liquidity, the typical fund in the venture cycle, like 20 years ago, the average liquidity was 5 to 7 years, and funds would be liquid and fully returned to investors. These days, it's taking 10, 12, 15 years if you're a primary LP in a fund. And the chart on the left shows that just is based on PitchBook data and looking at some of the more recent cohorts. It's taking 7 or 8 years just to get some kind of meaningful returns, 0.5x or so. And it's up to 15 years now to get your full return on the fund, which for a median early stage venture fund is somewhere between 2 and 3x as we stand. And the reason is companies are just taking much longer than they used to go public. When Dave and I were at PayPal, that company was founded in 1998 and public in 2002. So it was a 4-year window from founding all the way to a liquid IPO. And that was $1 billion IPO, which back in the day, that was a big IPO. But nowadays we're seeing $50 to $100 billion IPOs from companies like Snowflake and then Airbnb and Palantir. But they're taking 12, 15, 17, 18 years to get liquid and doing multiple later stage rounds from private equity and from later stage VCs. So what that means now for these for venture investors is that what used to be a 4 or 5 year holding period has now extended out to 12, 15, 17 years. And that's one of the reasons why there's a desire to sell and get some liquidity and why they might be willing to accept a discount. So for our investors in the secondary fund, we're jumping in at the halfway point. So 5 to 7 years into a fund, which means the fund has only another 5 or 7 years to go before its distributions and ultimate realization. So for our investors, it's a much shorter 5 to 7 year window to get to liquidity. There are a couple of questions here about discounts, and maybe I can take the first one. Just why are there discounts here in venture and in private equity? The observation is the discounts tend to be a lot lower. If you look back at the PE industry about 15 to 20 years ago, there were discounts at 10, 20, 30% from the NAV. Now it's gotten a lot more liquid, a lot more efficient. You actually have a number of players who are secondary traders in PE, playing in the public markets and just raising a lot more money. And as Dave's chart shows, that's now become a $100 billion, just VC secondary relative to PE is just way less mature. PE is now a $100 billion and counting industry. And it's become a lot more efficient and a lot more thoughtful about valuations and pricing. There are discounts to be had, but it's gotten very tight. And in some cases, in private equity funds, you actually might end up paying a premium to the valuations that the companies are being held at. In VC, it's just a much younger, much less efficient market. It's only now having some kind of liquidity and some kind of transactions. Secondary companies in the venture-backed space, companies like Stripe or Airbnb or Palantir before they went public, they were seeing pretty active secondary markets at or close to the last price round. But that's a very small piece of venture. Venture, for the most part, is still a lot of Series B, C, and D companies. They're growing quickly, but they're hard to value. The financial information around them is very thin. And so these portfolios are just less liquid and trade at significant, in some cases, significant discounts to the underlying NAV. In the transactions we've done, we've been between a 20 and a 42% discount to NAV. And these are portfolios that are fairly highly concentrated in well-known, fast-growing unicorns. So companies that we know and we understand, but just the market doesn't properly value these assets today.
Yeah, and I'll also point out that in venture capital, at least some of the companies are smaller and less established. So one difference that you have in private equity secondary is it's easier to really get a handle on the price of the underlying assets because they tend to be larger. In venture capital, some of the companies are more mature and developed, and some of them are larger and easier to assess, but many of them may not be an immediate exit opportunity. That might be substantially less than $1 billion. And for companies that are maybe only valued at 100 million to 500 million, it's less clear when they are going to IPO or even if they're going to IPO. And for companies that are less than 100 million in size, there might be some skepticism about whether they will even exit at all. I also mentioned before, one of the big differences is we're looking at a basket of assets rather than a single asset. So on the individual company level in venture capital, there is a lot more competition now for secondary. And again, we've seen the arbitrage decrease over time where you might have been able to buy secondary at the company level in venture capital at 20 to 30% discounts 5 years ago, or maybe even more, but that's become a lot more competitive recently. Again, at the fund level, we kind of have to look at a basket of those assets and figure out which ones are likely to exit and when. And that creates a little bit more complexity and uncertainty. So because of that, there's usually fewer buyers and there is more arbitrage. Over time, this might get a lot more competitive and maybe that arbitrage will go away. But right now we are seeing pretty substantial discounts, again, at least 20 to 30% and sometimes more. Now, what's going on there is really people are looking at those assets and they're valuing the unicorns or potential IPOs, fairly substantially, but they may have less certainty about everything else that isn't quite that large or isn't quite that fast growing. And so we'll use the soundbite that sort of unicorns matter and horses are discounted. If we sort of take the horse mythology and metaphor here, we might look at a portfolio as grouped into 3 different types of assets. The ones that are larger and faster growing might be unicorns. We use the term centaurs, or you might call them soonicorns, for companies that are maybe between 100 million to $1 billion in value. These might still be, likely or possible exits, but maybe not immediate, maybe not in the next 1 to 3 years, but maybe more in the 3 to 5 years. They might not be an IPO, they might be an acquisition instead of an IPO. And then the least magical of creatures might be these companies that are less than 100 million in size, which we not so wonderfully call just horses. And we would say these are maybe a high level of uncertainty whether they're going to exit or not. So we do that initial grouping into size, typically based on valuation or revenue. And then we might also look at how fast those companies are growing. And again, these are general ranges, but we would say they're attractively growing if they're growing at 50 to 100% or more. They're interesting when they're growing at 20 to 50%, and they're maybe less interesting when they're growing at less than 20%. And so, again, most people are competing for the individual company secondary opportunities when they're large and fast growing and well known. And you'll see in this upper right-hand corner, there may not be any discount as all, as Aman was mentioning. There may be a premium that you pay for large and fast growing assets. But in most of the other areas, there's probably some discount or uncertainty that's placed on those companies' exit possibilities. And that's where there's quite a bit of arbitrage and opportunity for buyers who are more informed and maybe more familiar with how that trajectory works out. So we usually do kind of a bottoms-up analysis of the significant assets in a portfolio, and we try and group them into near-term likely opportunities and maybe medium-term not so likely and then less likely. And we build an overall assessment of what we think that value is. So that's usually how we come up with some type of price, and probably also why, again, there's a little bit more opportunity and arbitrage in buying fund secondary than in buying just company secondary. Over time, that may go away, but we think right now there's quite a bit of opportunity there. I think there's a question about who's the competition. I'll lay out maybe a couple of different ways to look at competition. We tend to look at both the difference between buying fund secondary versus company secondary. And then we look at maybe later stage opportunities that are funds that are between 10 to 15 years and maybe companies that are closer to IPO versus maybe early stage, which might, in our opinion, be less than 10 years and even as early as 5 years. So there are a lot of people that are definitely buying company secondary, and there's a lot of competition there. In fact, there's even several retail platforms like EquityZen, Forge, and Carta where people buy and sell at the retail level. Those are probably for companies that are already at a unicorn size and value and probably well known. Not very much arbitrage there. Then there's also professional buyers of company secondary when the companies aren't quite at a level unicorn, but they might be on their way. And there's also people that are buying fund secondary at the private equity stage and maybe some crossover into venture capital when those funds are getting towards end of life. These days, it's starting to see a lot more activity in what's called GP-led secondaries. These are where the funds are already maybe 10 to 12 years old or older. They're reaching the end of the fund life. And for a variety of reasons, the general partners may want to continue managing those portfolios, but give the existing LPs in those funds the opportunity for liquidity or to roll into a new vehicle. And there may be several folks that are both active in private equity and VC, like HarborVest and Collar. There's other folks who are specialists in venture capital, like Industry Ventures and Greenspring. Greenspring was recently acquired by a larger company and we see that there's a lot more consolidation happening in both private equity and venture capital. But at the fund secondary level, particularly between 5 to 10-year-old portfolios, there's not as much competition right now. And that's the area that we're focusing on. So even though I've identified competitors, I would say that probably most of the times we're not competing with other buyers. We're usually competing with the seller's decision about whether to sell or not. And that's probably the area where we can be creative and come up with some strategies that allow us to get at least a few sellers off the fence and opportunities for us to buy. I think
Dave,
Aman is also, yep, go ahead.
You also have some questions in the Q&A box, just so you know. I can read them to you or you can see them. Okay, cool.
We can take them. Yeah, there are a couple. Let me read a couple which I think are related. One is just how are the return expectations given just where the market is in the investment sector. And as a secondary firm, think about it as alpha and beta. So there's a segment of our performance that is that's going to be a result of us just finding attractive assets at valuations that we like, and then buying those at a discount to fair value of 20, 30, 40%. That's the alpha component. So that I wouldn't expect to change given a market dynamic. And as long as we can, find and source those deals and buy those assets and value them correctly and get them at a discount, that'll generate returns. And we think we'll be able to generate 20% plus net IRRs, and some of that is the alpha. If there is a downturn, we think that actually will widen, meaning there's more pressure on sellers who want to sell during the downturn, especially if the public markets are kind of wobbly. And so that means that there's better inventory that we can buy at a deeper discount and strengthen our alpha. Then there's the beta side, and that's really driven by just how do valuations in general perform in the market, and will Series B, C, and D companies at valuations today continue to perform? And I think that's a harder question. It probably depends a lot on which sectors perform and don't perform in a downturn. In general, I would expect that just given where valuations are, we'll continue to see progress and traction in certain sectors, like SaaS, for instance, is one sector that is very favorably received by public markets. It's doing well. Lots of great companies have been able to get public, and it's still early innings of a multi-year cycle of expansion. The SaaS companies that we're investing in they've got deep franchises, strong vertical traction, lots of customers, net retention rates that are over 100%. And so they're growing at 30, 40, 50% year over year or better. And I think a lot of that will continue even in a down market or a downturn. They'll just keep taking share from on-premises software and different software models. Even today, all the SaaS, PaaS, infrastructure as service, all that is about a 20% share of all tech spending. So lots of room to grow and lots of room to take share. The same, I think, of e-commerce, the same, I think, of fintech. These are growing categories that are taking share from traditional offline spaces. And we've seen in up and down cycles how they continue to take share. So I think the real question is just on valuations, and will they hold up, and can we offset that beta risk with just how we price? If the market doesn't perform well, we'll just factor that into our pricing and the discounts that we're able to buy at. Certain tech sectors are definitely, on a relative basis, more heated, and I think those present more risk. That's probably more of a primary market risk, and secondary firms have the advantage of just being able to take into account these pricing and valuations, and we would just widen our discounts from 20% to 30% or 30% to 40% in the event of a downturn.
Yeah, I think there's another question on this topic: how will current valuations impact your fund versus prior funds? So again, we do realize that we're in a very competitive valuation environment, and some people might feel that valuations are high relative to historical averages. I think Aman has actually done some analysis on this topic to look at, PE multiples and also percentage of the overall market that's compared on a venture capital basis to the overall size of the market. But I would say, the benefits of our strategy, one is that we are starting out getting in at a discount, typically at 20 to 40%. So we kind of feel like we're ahead of the game, at least a little bit there. And in case things are, optimistically priced, we feel like that discount might offset any reduction in market multiples in the future. The other thing is we're buying portfolios that have companies where the underlying companies, probably more than half the portfolio, are growing at 50 to 100% per year. And if there is, increase in interest rates or a reduction in market multiples, we should see that those growth rates will likely offset the market multiples within just a year timeframe. So we do think we have some cushion that we get because of that initial secondary discount. But probably more importantly is that we're identifying portfolios that we think are growing at 30 to 50% per year themselves. That's really one of the biggest reasons that we think the strategy is going to be successful. I think there's one other question about co-investment opportunities and maybe what the ticket size is. In general, we do try and make co-investment opportunities available for our fund investors, particularly at the company level. At the fund level, if we see transaction opportunities that are larger than 10 million in size, we'll probably open up some of that as participation opportunities to our LPs. And at the company level, where we see transaction opportunities larger than $1 to $2 million, we'd probably again open that up to our LPs to participate as well. I think the question on the ticket size, we're still going to be accessing smaller investors right now, at least for our first close. We will take investors below $5 million for the first close. Once we get into next year and subsequent closes, we'll probably be emphasizing investors at the 5 million plus level. But currently we're taking institutional investors at 1 to 5 million and up, and we will take individual investors at 250K and up. Is a replay going to be available, and can we share the presentation with participants? Yes, we can share the presentation. I think we'll also be a replay that Jeremy's suggesting that will be available. And for folks who'd like to contact us directly, you can email Steph@practicalvc.com. That's STEPH@practicalvc.com. That's also in the chat, and we can follow up with a presentation for you directly.
Yep. There was also a prior question about financial information and what do we get, and I answered that in the chat. We can talk a bit about that. The good news is when we are talking to funds and general partners, they will share with us their financials, which goes out to their LPs. All the deals we're doing are friendly transactions with GPs. So we're not doing hostile takeovers, or we're not like Carl Icahn type activist investors. We're the good guys in the story, and the GPs will share the information with us, including like share counts, what they know about the companies, and potentially price per share. Now all that is sensitive information and typically under NDA, so there's a limit to how much we can really get from the GP. And when it comes to the companies, the underlying assets that they own, typically they will not share that information with us, which would include like financial, like revenues, board minutes, stuff like this. We don't take board seats. We're not actively involved investors, so we don't have access to that kind of information. So it's really up to us in a portfolio of 100 companies we'll have to figure out which companies really matter. There's usually about 8 or 10 that really matter. And then it's up to us to source and diligence that information on our own. And the good news is, between Dave and myself, we've been investing or co-investing with investors here in the Valley and in the US and around the world for about 20 years. So we're on friendly terms with a lot of investors, a lot of GPs, a lot of employees of these companies who want to sell their shares. They'll provide us with the information that we need in order to get comfortable with the valuation policy for the firm, what our willingness to pay is based on their revenue, their profitability or path to profitability, their cap tables, their share counts, and everything else. So that's part of what makes secondary interesting and also inefficient, is that there's just not that many people who can get at that information in a quality way and make sense of it. And luckily, Dave and I have been doing this for 20 years, so we know a little bit about cap tables and share counts and how to get information from our network.
There's a question about the terms, and we can share some of the terms here. Again, this is noting a minimum check size of 5 million. Just to clarify, that'll be, once we get the first close done, we'll be limiting investors to a $5 million minimum, but at least before first close, we'll be taking smaller checks from both individuals and institutions. The terms of the fund are generally that it's a 7-year vehicle. We'll charge about 1% annual management fee for those 7 years. Alternatively, people can pay a one-time fee upfront that's 5%. This lists a GP commitment that's only 1% to 2%, but we've made a 5% commitment to all of our previous transactions. We're planning to make a commitment of at least $10 million to the fund, if not more, personally. So we are significantly invested in the fund, and it is a big part of what we care about, not just the profits as well. There's a question in the Q&A about how quickly do we expect to call capital. I would expect we'll call 100% of the capital within the first 18 to 24 months. I believe our first capital call will probably be about 30 to 35%. And sorry, there was a question, no carry. We definitely do charge carry. That carry is between 15 to 30% based on performance. We won't charge any carry until we get to at least a 1.5x net hurdle. If we do between 1.5x to 2x, we'll charge 15%. Assuming we do better than 2x net, we'll charge 20%. And if we hit a stretch target of more than 3x net, then we'll charge 30%.
Yeah. There's a question about what investment have you made personally in the fund. I think Dave addressed a lot of this, but in our first, we've been doing this for about 2 years. In our first, let's say, the first 2 years, we've done 6 SPVs now, and I think on average, our GP commitment or sponsor commitment is somewhere between 5 and 10% for all of them. And I think all of them fit in that range. I think we would as we're raising $150 million fund, it'll be a minimum of 1%. That's in the legal terms of the fund documents, but we're actually planning on a more substantial GP commit, probably somewhere between 5 and 10% of the fund as well. A lot of this just depends on liquidity and what assets we have available, and we're also taxpayers in California, where the tax rates can get up to about 52% right now. So how we do this without without triggering tax events and liabilities is part of what we're doing. But the good news is you will be co-investing with my kids. The Amon Verji family will be a meaningful LP. If it's not meaningful for the fund, it's certainly meaningful for my kids. They'll be watching with interest to see how we do and whether they get to go to university or not.
Question from Paul Bachow. I'm sorry if I'm mispronouncing that. Is there a catch up on the promote as you exceed a tier? Yes. So assuming that we do at least 2x net, we would charge a 20% carry. If we exceed the 3x net target, it would be 30%. Another question was, is this available on advisor platforms like Schwab Institutional? Not at the current time.
And we will accept retirement. So even though we're not available on a platform like Schwab, I guess what I would say is if you have money, there are some challenges in getting money from like Schwab into a fund like ours. It's a private placement. So depending on your relationship with Schwab, they may do it or they may not. IRAs and stuff like that are supported by some, but not Schwab specifically. So if you have an IRA, if you have a retirement fund, if you have If you have a vehicle like that, we can certainly accept it. We just have to work with a intermediary or an advisor who will do it. And it looks like there's somebody in the chat who has offered their help and services. They can help to do private placements, and so that's that's great. And if it's something you also want to do and you just want to research, feel free to reach out to us, and we'll help you. We'll help you figure out how to get your IRA or other investment retirement vehicles into the fund. We've done that for lots of our LPs.
I think we've caught up on most of the questions. Again, we can talk to you guys more if you'd like to have more specific questions about strategy or fund. I'll maybe just wrap up with a few other items. I mentioned that we've invested with a lot of firms here in Silicon Valley and around the world. We've been investing in venture for over 12, 15 years. We've worked with people at PayPal and invested alongside with a number of later stage and early stage VC funds, some of which have actually been investors in our firms and funds as well. And we've also started about 20 other small funds over the years and been advisors and LPs in 20 or 30 other funds. So we do have quite a bit of folks that we've co-invested with here in Silicon Valley and around the country and around the rest of the world. Maybe I'll just drop in, and this is an example of one of the transactions that we've done in the past. The SPV we did probably about 18 months ago was buying secondary interests in a fund that I used to manage previously at 500 Startups. This was our first fund. This was about a 10-year-old portfolio when we purchased it. We did two transactions in this portfolio. I think we acquired about overall about $8-10 million worth of interest in the portfolio, and then some direct positions as well. This portfolio started with a very large number of companies, but again, after 9-10 years, it was really 4 significant assets: Talkdesk, Lucid, Intercom, and Udemy, which were the primary assets. Those at the time we purchased represented about 50-60% of the portfolio. Now they're representing close to 90% of the portfolio. There was a longer tail of assets that were still interesting companies, but maybe not the majority ones. So when we looked at this portfolio, we really were identifying those top 4 candidates. Since the time we've made this transaction, Udemy is a company that's actually gone public just recently. And we do expect that the other 3 companies, Talkdesk, Lucid, and Intercom, will probably IPO within the next 12 to 24 months. As an example of how this transaction worked, the initial SPV, we raised about $5 million. We used about $4 million of that $5 million to buy LP interests. Those LP interests were actually worth about $7 million, although we bought them for $4 million. And then another $1 million, we've made direct company investments in about 4 companies. There was a small amount of management fees and expenses that we used, but then we had pretty substantial markup in the overall portfolio based on the first day we purchased the transaction. This particular deal we got at about a 40% discount to NAV. And then in the subsequent year or year and a half or so, we've seen substantial markups in the portfolio. Talkdesk went from a $1 billion valuation at Series B to a $3 billion valuation at Series C, and then most recently at a $10 billion valuation in a Series D investment. There were also substantial markups in the rest of the portfolio companies in that group. And there was even some partial secondary where we've already made distributions back to our initial LPs. So fast forward after 18 months, this portfolio is up actually about 4x, and we've already seen close to 40 cents on the dollar back in distributions to our LPs. The remaining assets that are held are probably equally about Talkdesk. I guess it's probably more about 60 to 70% of that portfolio. Again, that company's been doing quite well, about 200 million in revenue, growing about 75 to 100% per year. And there are other companies there that we expect to be IPOs in the next 2 years as well. If we don't have any further questions, I think we'll just kind of wrap up here. And again, just to summarize the strategy again, why we think the benefits are substantial. We're looking at portfolios that we believe already have substantial value, already have companies that are working, already are on their own track to an exit or IPO. We can usually buy these portfolios at least at a 20% discount, in some cases up to a 30 to 40% discount, and we're starting off ahead of the game. And then in contrast to maybe other VC funds that maybe take 10, 12, 15 years, in our general portfolios, we're planning to hold these assets for maybe 5 to 7 years. We're looking for a quick return of at least the first 1x back within the first 2 or 3 years. If there's no other questions, then I think we'll probably.
I had a question submitted
Yes,
to me, which was, do you guys have any exposure to crypto-related VC businesses or any in that sector?
I guess we personally are investors in 3 other crypto funds run by some folks that we know and have worked with in the past. That's not part of the current strategy that we're offering, although we might make that available on a case-by-case basis. Probably a little bit of a different risk profile and strategy in buying crypto assets. So I guess we're also interested in crypto, but we have some folks that we think are specialists in those areas that we've worked with. One in Israel, one here in California, and another in Midwest.
Yeah.
Okay, cool.
Won't be material in the fund though. At least we don't expect it to be. There will be some functional blockchain, maybe vertical blockchain companies in the portfolio that I think will be, I don't know if it'll be material or not. It's not one of our emphasis categories. Those are really SaaS, e-commerce, fintech. Usually we're looking for companies that are little later stage. Maybe some exchanges or wallets might become material, but crypto itself, probably not a material part of the fund. Maybe available on a co-investment basis if that's something folks are interested in.
Another one is, how do you get your ideas to source? Is it just based off of like industry trends, employees? Like, what's kind of that process?
Yeah, I think probably 70-80% of our strategy will be focused on areas that we are very comfortable with and we have quite a bit of experience. As we mentioned, enterprise SaaS, B2B, e-commerce and marketplaces, and fintech probably are the bread and butter, or meat and potatoes, if you will. Ahmad and I have quite a bit of history in fintech, having started at PayPal 20 years ago. We've got quite a bit of experience investing in SaaS and e-commerce companies over the last 10 to 15 years. We may explore other categories as well, and we've certainly worked with a lot of other fund managers who have expertise in different areas. So we might dabble in a few other areas, but those are probably the ones that we've looked at the most. I would say one other area of expertise we have is we've done quite a bit of investing outside the US and in other international markets. When I was running and managing 500 startups, we invested in over 75 countries around the world. We had team members in offices in about 15 to 20 countries around the world, and we started funds in about 10 other countries. So we do know quite a bit of opportunities outside the US. Right now, I'd still say the strategy for our fund focus is probably primarily 70-80% in the US, but we do see substantial opportunities in markets like Latin America and Southeast Asia, probably India and Europe, that we think are interesting. And in some cases, there's even greater arbitrage in those markets to go after. I think we do, reach out to a lot of other funds in the market and try and figure out, where we can find strategies that we think are reliable. We probably, again, would emphasize ones where we have personal experience and connections.
How often are you guys making those acquisitions of new stakes?
Right now, I'd say we'll probably plan to do 1 to 2 transactions per quarter, maybe up to 3. We would plan to deploy the fund probably over a 2-year period across at least 10 to 15 funds, maybe up to 20. Within each of those funds, we'll probably do anywhere from 1 to 3 company level investments, although a little bit smaller check size for those. So I would generally say probably around 2 investments per quarter, maybe up to 3.
Okay, thank you.
All right, I guess thanks again for everyone's time today, and appreciate the opportunity to share what we're doing with folks. We think this is a great category. It's fairly new and not as much folks jumping in right now. So I'd love to help explore that with you guys if you're interested.
Why don't you give everybody your contact information again, just so they have it?
Sure.
Absolutely. Again, for specific questions on the terms of the fund, you can contact Steph, and her email is in the chat. But that's Steph, STEPH, @practicalvc.com. If people have direct questions for either me or Aman, I'm Dave at practicalvc.com. And Aman is Aman, A-M-A-N, at practicalvc.com.